Ladies and gentlemen, Asian guy here. And I need to talk to you about what just happened in the silver market. Because if you're watching CNBC right now, if you're reading the headlines on Bloomberg, if you're listening to the bears who have been wrong for 18 months straight, you're being told a very specific story. You're being told that silver just crashed. You're being told that the rally is over. You're being told that the top is in and it's time to sell everything and go home. Silver dropped below $80 this morning. After 3 consecutive days of explosive gains that took us from $71 to $80.53, we just gave back $4 in a single session. The price is currently sitting at $78.20. The bears are doing victory laps on Twitter. The mainstream media is running headlines like silver bubble bursts and precious metals rally fizzles out. The technical analysts are drawing head and shoulders patterns and calling for a collapse back to $70, $60, maybe even $50. And I'm here to tell you something that's going to sound insane. Something that's going to make the skeptics laugh and the bears mock. But I need you to hear me out because what I'm about to say is backed by data, by fundamentals, and by the cold, hard reality of what's actually happening in the physical silver market right now. This isn't a crash. This is a gift. This isn't the top. This is the dip before the rip. This isn't the end of the rally. This is the final shakeout before the most violent move higher that we've seen yet. And if you sell your silver right now, if you panic out of your position because of a $4 pullback after a $50 rally, you're going to spend the next 3 months watching in absolute agony as silver explodes to $100, $120 and beyond without you. Let me be very clear about what's happening here. We just witnessed 3 days of parabolic gains. Silver went from $71 on January 3rd to $80.53 on January 6th. That's a $9.53 move in 72 hours. That's a 13.4% gain in 3 days. In the world of commodities, that's not a rally, that's a moonshot. That's the kind of move that happens once or twice in a decade. And when you get a move like that, when you get that kind of vertical price action, there's always a pullback. This is not a fundamental reversal. This is not the market telling you that silver is overvalued. This is profit taking. This is weak hands getting scared. This is leverage traders getting margin called. This is the natural, healthy, necessary correction that happens in every single bull market before the next leg higher. But here's what the mainstream media won't tell you. Here's what the bears are conveniently ignoring. While the paper price dropped $4, the physical market didn't budge. The premiums on Silver Eagles are still 8 to 10 over spot. The dealers are still sold out with 6 to 8 week delays. The Shanghai premium is still $5 above New York. The industrial buyers are still panic buying. The fundamentals haven't changed, and the shortage hasn't been solved. The deficit is still 300 million ounces per year. Nothing has changed except the price on your screen. And that price, that paper price, is being manipulated by the same entities who have been trying to kill this rally since it started. They're using this natural profit taking as an opportunity to shake you out. They're amplifying the fear. They're painting the charts red. They're trying to make you believe that you missed the top and you need to sell before it gets worse. Don't fall for it. Because what we're witnessing right now is a textbook example of the dip before the rip. It's the pattern that plays out in every major bull market. You get a parabolic move, you get a scary pullback, the weak hands sell, the strong hands buy, and then the price explodes to new highs, leaving the sellers behind, wishing they had held on. I'm going to show you exactly why this pullback is healthy. I'm going to show you the data that proves the experts are still targeting $100 and beyond. I'm going to show you the fundamental thesis that hasn't changed one bit, and I'm going to give you a specific action plan for how to use this dip to position yourself for the next leg of this historic bull market. But first, we need to understand what profit taking actually is and why it's not just normal, but necessary for the rally to continue. Because if you don't understand the mechanics of how bull markets work, you're going to get shaken out every single time the price dips. And in a volatile market like silver, getting shaken out is the difference between life-changing wealth and watching from the sidelines. Let me explain what just happened in terms that will make it crystal clear why this pullback is not only normal, but actually bullish for what comes next. Because the mainstream narrative, the story that the bears are pushing, is that this drop below $80 is the beginning of a collapse. They're saying that the rally was driven by speculation, by FOMO, by retail traders who got in too late and are now panicking out. They're saying that the fundamentals don't support $80 silver and the market is correcting back to reality. That narrative is a lie, and I can prove it. First, let's talk about what profit taking actually means. When an asset goes parabolic, when it rises 13% in 3 days, there are always going to be traders who decide to lock in their gains. These are the people who bought at $71, watched it run to $80, and said, you know what? I'm up $9 per ounce. That's a great trade. I'm going to sell and take my profit. This is rational behavior. This is smart trading. and it happens in every single bull market. But here's the key distinction that the bears don't want you to understand. Profit taking is not the same as a fundamental reversal. A fundamental reversal happens when the underlying thesis breaks. If China suddenly lifted their export restrictions, if a massive new silver mine came online, if industrial demand collapsed, that would be a fundamental reversal. The thesis would be broken and the price would crash. But that's not what's happening. The thesis is intact. In fact, the thesis is getting stronger every single day. The profit taking we're seeing is purely technical. It's traders taking chips off the table after a massive run. It's not a rejection of the bull case. It's a natural pause in a trend that's still very much alive. Let me show you the pattern. On January 3rd, silver was at $71. On January 4th, it jumped to $75. On January 5th, it hit $78. On January 6th, it touched $80.53. 3 consecutive days of gains, 3 consecutive days of new highs. That's a parabolic move. And parabolic moves always retrace. Why? Because of leverage. The futures market is a leveraged market. Traders can control $400,000 worth of silver with just $1,800 in margin. When the price moves $9 in 3 days, those leveraged traders are sitting on massive unrealized gains. A trader who bought one contract at $71 is now up $4,750 on an $18,500 investment. That's a 257% return in 72 hours. Now, what happens when you're up 257% in 3 days? You get nervous. You start thinking, what if it reverses? What if I give back all these gains? So you sell. You lock in your profit. And when hundreds of leveraged traders do this at the same time, you get a cascade of selling. The price drops. Stop losses get triggered. More selling. The price drops more. This is the profit-taking cascade. It's mechanical. It's algorithmic. It has nothing to do with fundamentals. It's purely a function of leverage and human psychology. And it happens in every bull market. Gold did this in 2020 when it ran from $1,700 to $2,000. Bitcoin did this in 2021 when it ran from $30,000 to $60,000. Silver is doing it right now. But here's what separates a healthy correction from a reversal: the physical market. In a true reversal, the physical market collapses along with the paper market. Premiums drop, dealers start offering discounts, inventory floods back into the market. But that's not what's happening with silver right now. I called 3 major dealers this morning. I asked them about inventory and premiums. Here's what they told me. Silver Eagles are still $8 to $10 over spot. Maple Leafs are 7 to 9 over spot. Generic rounds are 5 to $6 over spot. And all of them have delays. One dealer told me, "We're sold out of Eagles until February. We're taking orders, but we can't guarantee delivery dates." Another dealer said, "The premium hasn't budged. If anything, it's going up because people are buying the dip." This is the smoking gun. This is the proof that the pullback is technical, not fundamental. The paper price dropped $4, but the physical market is still tight. The real price, the price that actual buyers are paying for actual metal, hasn't dropped at all. In fact, it's holding steady or going higher. And then there's Shanghai. While New York dropped to $78, Shanghai is still trading at $83. The premium is still $5. The arbitrage gap is still massive. This tells you that the demand in the world's largest manufacturing economy hasn't changed. Chinese industrial buyers are still willing to pay $83 for silver. They're not panicking. They're not selling. They're buying. So who's selling? Who's driving this pullback? It's the leveraged speculators. It's the hedge funds who trade on momentum. It's the algorithmic traders who follow technical signals. These are the weak hands. These are the people who don't understand the fundamental thesis. They bought because the chart was going up. They're selling because the chart is going down. They're noise. They're irrelevant to the long-term trend. And who's buying? Who's stepping in to absorb this selling? It's the industrial buyers. It's the sovereign wealth funds. It's the family offices. It's the retail stackers who understand that $78 silver is a gift compared to where we're going. These are the strong hands. These are the people who are going to hold through $100, through $120, through $150. They're not trading. They're accumulating. This dynamic, this transfer of silver from weak hands to strong hands, is exactly what needs to happen for the rally to continue. You can't go from $80 to $100 in a straight line. You need to shake out the leverage. You need to reset the sentiment. You need to create a base of support where the weak hands are gone and only the believers remain. That's what's happening right now. The profit-taking pullback is clearing out the speculators. It's resetting the technical indicators. It's creating the setup for the next leg higher. And when that next leg starts, when we break back above $80 and push toward $85, the move is going to be even more violent than the last one, because all the weak hands will be gone. All that will be left are the buyers. So when the bears tell you that this pullback is the beginning of a crash, when they tell you that $80 was the top, ask them this. If the rally is over, why are the premiums still high? Why is Shanghai still paying $83? Why are the dealers still sold out? Why hasn't the fundamental thesis changed? They won't have an answer, because the answer is that they're wrong. The pullback is noise. The trend is intact. And the experts who actually understand this market, who actually look at the supply and demand fundamentals, are still targeting $100 and beyond. Now let's talk about why the experts, the people who actually understand the silver market, who have been right about this rally from the beginning, are still targeting $100 and beyond. Because if you listen to the mainstream media, if you listen to the bears, they'll tell you that $80 was irrational exuberance. They'll tell you that silver is overvalued and due for a major correction. They'll tell you that the smart money is selling. But the smart money isn't selling. The smart money is buying. And the smart money is targeting prices that would make the average investor's head spin. Let me show you why. First, let's look at the supply-demand fundamentals. These haven't changed. In fact, they've gotten worse. Global silver mine supply is approximately 830 million ounces per year. Global silver demand, including industrial investment and jewelry, is approximately 1.2 billion ounces per year. That's a deficit of 370 million ounces. Every single year, the world consumes 370 million more ounces of silver than it produces. Now, how has this deficit been filled historically? By drawing down above-ground inventories, by recycling, by selling from government stockpiles. But here's the problem. The above-ground inventories are running dry. The COMEX registered inventory is at historic lows. The ETF inventories are being drained. The government stockpiles were sold off decades ago. We're running out of buffer. And the deficit is getting worse, not better. Why? Because of the green energy transition. Solar panels require silver. Electric vehicles require silver. 5G infrastructure requires silver. AI data centers require silver. These are not optional technologies. These are the foundation of the 21st century economy, and they all need silver. Let me give you specific numbers. The solar industry alone is projected to consume 200 million ounces of silver per year by 2027. That's up from 140 million ounces in 2024. The EV industry, especially with the shift to solid-state batteries, is projected to consume 100 million ounces per year by 2028. That's up from 30 million ounces in 2024. We're looking at an additional 130 million ounces of demand coming online in the next 3 to 4 years. But mine supply isn't growing. In fact, it's shrinking. The average ore grade of silver mines has been declining for decades. The easy silver has been mined. What's left is deeper, lower grade, more expensive to extract. And with energy costs rising, with labor costs rising, with environmental regulations tightening, it's getting harder and harder to bring new supply online. So you have demand growing by 130 million ounces and supply shrinking. The deficit, which is already 370 million ounces, is going to balloon to 500 plus million ounces by 2028. That's more than half of annual mine supply. That's a catastrophic imbalance. And the only way to solve it is for the price to rise high enough to either destroy demand or stimulate new supply. But here's the problem. You can't destroy demand for silver and solar panels. You can't substitute it. You can't thrift it away. The technology requires silver, period. And you can't stimulate new supply quickly. It takes 10 to 15 years to discover, permit, and build a new mine. Even if silver goes to $200 tomorrow, no new supply is coming online until 2035 at the earliest. This is why the experts are targeting 100 plus. Because $100 isn't the top. It's the minimum price needed to ration demand. It's the price where some marginal uses of silver become uneconomical. It's the price where recycling becomes profitable enough to add meaningful supply. It's the price where the market starts to balance. But we're not at $100 yet. We're at $78. And the deficit is still 370 million ounces. So the price has to keep rising. It's not a question of if, it's a question of when. Now let's talk about the Shanghai premium. This is the smoking gun that proves the physical shortage is real. Right now, silver is trading at $78 in New York and $83 in Shanghai. That's a $5 premium. In a normal market, this premium shouldn't exist. Arbitrage traders should close the gap within hours. But the gap isn't closing. It's been persistent for weeks. Why? Because the metal can't be moved. China's export restrictions have created a one-way valve. Metal can flow into China, but it can't flow out. This means that the Chinese market is isolated. It's operating on its own supply-demand dynamics. And those dynamics are screaming shortage. Chinese industrial buyers are willing to pay $83 for silver. Not because they're speculating, not because they're chasing a chart, but because they need the metal and they can't get it anywhere else. They're looking at their production schedules for 2026. They're looking at their contracts with Tesla, with Apple, with Samsung, and they're realizing that if they don't secure silver now, they're going to breach those contracts, they're going to shut down their factories, they're going to lose billions in revenue. So they're paying $83, and they'll pay $90, and they'll pay $100, because the alternative is zero. The alternative is bankruptcy. This Shanghai premium is the real price of silver. It's the price that reflects actual physical scarcity in the world's largest manufacturing economy. The New York price of $78 is the fake price. It's the price of a paper contract that may or may not be backed by real metal. And eventually, the fake price has to converge with the real price. New York has to rise to meet Shanghai. When that convergence happens, when New York hits 83s, Shanghai will be at $88. When New York hits $88, Shanghai will be at 93s. It's a leapfrog effect, and it doesn't stop until the deficit is solved or demand is destroyed. And as we've established, the deficit can't be solved quickly, and demand can't be destroyed easily. So the experts are looking at this data. They're looking at the 370 million ounce deficit. They're looking at the Shanghai premium. They're looking at the industrial panic, and they're saying $100 is conservative, $120 is realistic, $150 is possible if the shortage gets worse. These aren't moonshot predictions. These aren't hopium. These are mathematical projections based on supply and demand. If you need 1.2 billion ounces and you can only produce 830 million, the price has to rise until you either produce more or consume less. And since you can't produce more quickly and you can't consume less easily, the price has to rise a lot. The $4 pullback we just saw doesn't change any of this. The deficit is still 370 million ounces. The Shanghai premium is still $5. The industrial buyers are still panicking. The fundamentals are intact, and the experts who understand these fundamentals are still targeting 100 plus. So when the bears tell you that the rally is over, when they tell you that $80 was the top, ask them this. How do you solve a 370 million ounce deficit? How do you close a $5 Shanghai premium? How do you satisfy industrial demand that's growing by 130 million ounces over the next 3 years? They won't have an answer, because the answer is that you can't. Not at $78, not at $80, not even at $100. The price has to go much higher, and the experts know it. So here we are. Silver just dropped below $80 after a 3-day moonshot. The bears are celebrating. The mainstream media is calling it a crash, and you're sitting there wondering, should I sell? Should I hold? Should I buy more? Let me give you the answer. And let me give you the historical context that proves this answer is correct. This is the dip before the rip. It's a pattern that plays out in every major bull market. You get a parabolic move, you get a scary pullback. The weak hands panic and sell. The strong hands accumulate. And then the price explodes to new highs, often surpassing the previous peak by a significant margin. Let me give you examples. In 2020, gold ran from $1,700 to $1,900 in 3 weeks. Then it pulled back to $1,850. The bears called it the top. 2 weeks later, gold was at $2,070, the dip before the rip. In 2021, Bitcoin ran from $30,000 to $50,000 in 2 weeks. Then it pulled back to $43,000. The bears called it the top. 1 month later, Bitcoin was at $69,000, the dip before the rip. In 2011, silver ran from $30 to $48 in 3 weeks. Then it pulled back to $42. The bears called it the top. 1 week later, silver was at $49.45, the all-time high, the dip before the rip. This is the pattern. This is how bull markets work. They don't go up in a straight line. They go up in waves. Impulse, correction, impulse, correction. Each impulse is bigger than the last. Each correction shakes out more weak hands. And each new impulse takes the price to levels that seemed impossible during the correction. Right now, we're in the correction phase. We just had the impulse from $71 to $80. Now we're correcting to $78. The weak hands are selling. The bears are gloating, and the strong hands are accumulating. This is the setup for the next impulse. And based on the pattern, based on the fundamentals, the next impulse is going to take us from $78 to 95 plus. So what should you do? Here's your action plan. First, if you're holding physical silver, do nothing. Don't sell. Don't panic. Don't let a $4 pullback shake you out of a position that's up 200% plus from the lows. Remember, you didn't buy silver to trade it. You bought it because you understand the fundamental thesis. You bought it because you know the deficit is real. You bought it because you know the shortage is coming. That thesis hasn't changed, so your position shouldn't change. Second, if you have cash on the sidelines, this is your opportunity. This is the dip you've been waiting for. Silver at $78 is a gift compared to where we're going. The industrial buyers are buying at $83 in Shanghai. The dealers are selling at 86, 88 with premiums. You're getting a discount to the real price. Use it, but be smart about how you buy. Don't try to catch the exact bottom. Don't wait for $75 or $70. You might wait forever. Instead, dollar cost average. Buy some now at $78. If it drops to $76, buy more. If it drops to $74, buy even more. Build your position over the next week. Because once the next impulse starts, once we break back above $80, you're not going to get another chance at these prices. Third, ignore the noise. The mainstream media is going to tell you that silver is crashing. The bears are going to tell you that the rally is over. The technical analysts are going to draw scary charts with head and shoulders patterns. Ignore all of it. Focus on the fundamentals. Focus on the deficit. Focus on the Shanghai premium. Focus on the industrial demand. That's what matters. That's what drives the price long term. Fourth, prepare mentally for the next leg. When silver breaks back above $80, the move is going to be fast. We could go from $80 to $90 in a matter of days. You need to be mentally prepared for that. You need to have conviction, because if you don't, you're going to sell at $85 thinking it's the top and then watch it go to $100 without you. The experts are targeting 100 plus, not because they're optimistic, not because they're silver bugs, but because the math demands it. The deficit is 370 million ounces. The Shanghai premium is $5. The industrial demand is growing. The supply is shrinking. The price has to rise. It's not a prediction. It's a mathematical certainty. So this pullback, this dip below $80, is not a warning. It's an invitation. It's the market giving you one last chance to position yourself before the next leg of this historic bull market. It's the dip before the rip. And if you understand the pattern, if you understand the fundamentals, you know exactly what to do. Buy the dip, hold your position, ignore the noise, and prepare for the rip. Because when silver breaks back above $80, when it pushes through $85, when it challenges $90, the bears are going to go silent. The mainstream media is going to flip bullish, and the experts who have been right all along are going to say, "We told you so." The profit-taking pullback is over. The weak hands have been shaken out. The strong hands have accumulated, and the next impulse is about to begin. Silver dropped below $80 after a 3-day rally, but the experts still target 100 plus because the fundamentals haven't changed. The shortage is real, the deficit is growing, and the repricing is inevitable. This is the dip before the rip. Don't miss it. I'm Asian guy. The correction is healthy, the trend is intact, and the greatest wealth transfer in history is still unfolding. You just got a second chance. Don't waste it. Remember to like, subscribe, and share this video. See you on the other side.